Europe could only be 39 days away from the start of a major crisis and could even be in for a very cold winter as energy supplies may not be enough to last. And an energy crisis in Europe, the second largest economy in the world when taken as a whole unit, could have a dramatic effect on the price of energy worldwide, which could send inflation spiking much higher for, well, basically anything and everything from fertilizer to food to shipping to industry and much, much more. This could be the biggest and most important factor that could affect markets going into the end of the year. It's not just the crazy stuff going on in China. Europe's got its own crisis, and in this video I want to discuss what is happening and how it could affect your portfolio. My name's Lark. I make videos on investing. If you do like that topic, then make sure to subscribe to the channel and also take a quick second, tap on that thumbs up button. Let me know you do appreciate this kind of content. So what are the roots of Europe's gas issues? How did we get here? Well, natural gas prices in Europe are actually 4 times higher already than they were at the start of the year. They continue to rise, as this chart here shows. But why? Well, there are a few key reasons for this to be happening. The first, of course, is increased demand, and it's a global thing when it comes down to energy as countries are starting to come out of lockdowns, they're restarting their economies, and as well, of course, as the reality that China and India are continuing to grow and demand more energy for manufacturing industries and all the stuff that they've got going on. But the much bigger issue in a Europe-specific context, of course, is the escalating tensions between the European Union, the UK, and Russia. Even before Ukraine, the relationship was pretty tense, with Russian state-owned energy corporation Gazprom actually sending the EU 24% less gas in Q4 of 2021. That alone caused a supply shock, resulting in prices to soar. That led to the EU to announce that they were gathering evidence for a probe to find out if the price spikes were due to manipulation by suppliers such as Gazprom. And then, early this year, just 2 days after Germany halted certification on the Nord Stream 2 gas pipeline, which was going to fix Europe's gas woes, well, guess what happened? Russia decided it was a good time to invade Ukraine, which led to the third major factor on energy prices in the EU, the sanctions regime against Russia. After the start of the war, the EU, the UK, the United States all imposed wide-ranging sanctions against Russia, including an import ban on Russian oil, but also targeting Russia's gas industry. And Russia is the largest supplier of gas to Europe. As of 2020, 43.4% of EU's gas came from Russia, as this chart here shows. Now, this created another supply shock, with Europe left to find other countries to try to supply them with that gas. Countries such as Norway are stepping in to try to fill that void, and further sanctions have now been imposed, with the EU doubling down on their stance. This time on Russian coal imports, which of course unsurprisingly sent the price of coal up to record highs. This is happening despite the concerns of a continued energy crisis moving into winter. So that all leads to the current problem. The reality, winter's coming, and it gets pretty cold in Europe. October 1st is being frequently cited as the start of the heating season in Europe. That's only 39 days away. And the goal for EU countries right now is to have 90% storage of gas. Currently, the gas storage in Germany is 80%, but countries like Hungary and Bulgaria only around 60% currently. Although European gas storage is technically in a much better place than it was at the same time back in 2021, it is also on pace to end the summer with over 3.43 trillion cubic feet of gas in storage, as you can see on this chart here. But we must account for the fact that storage alone may not cover Europe's needs without those fresh inflows coming from Russia. See, last year they had storage plus fresh gas coming from Russia, because on average, Europe uses around 4 trillion cubic feet of gas. And that depends on the country too and how much storage they have. This chart here shows how much storage each country had on August 1st versus their annual gas consumption. Not looking great in some countries, to be honest. Any further shutting down of pipelines or closing of US facilities as well could put significant risk to the already stored gas in Europe. Currently, gas futures contracts are pricing in the worst for Europe this winter. So how could a winter spike in demand affect prices? And of course, what may you as an investor be most interested in what's it going to do to the markets? Well, I'm going to tell you that in just a moment, but just let me break the flow real quick to let you know about Wealth Mastery. This is my value-packed cryptocurrency investor report. It comes twice weekly to your inbox as a newsletter. We talk about NFTs, altcoins, DeFi, airdrops for free money, and much, much more. Sign up for free using the link in the description. Okay, so unsurprisingly, demand for energy is usually much higher over cold winter months. Surprise! That has led the EU to, of course, voluntarily commit to try to reduce gas demand by 15% between the 1st of August 2022 and the 31st of March 2023. But also, Europe is currently facing its own summer issues that are spiking demand. We have record heat waves, people want to use air conditioning, we have record temperatures, wildfires, commuter chaos, all this kind of stuff going on, which has triggered new demands for keeping cool in the summer, which is spiking gas up. That has led to a big increase in demand for natural gas for electricity production. That, of course, increases fears that the winter stockpiles may not end up being sufficient. And it's not just about cold homes in the winter, although that's a big problem for your average person, but higher energy prices and shortfalls in supply, that impacts industrial production. That causes problems for the economies right across Europe. That could have a lot of terrible knock-on effects. This chart here shows natural gas prices in Europe, which are currently going absolutely parabolic, and that's not what you want to see for gas prices if you're a consumer or an industrialist. It's neither cool nor normal for the month of August. That's around 1,000% increase in a year. It actually surged another 20% today. This is leading to stories like this one, that a zinc smelter in Europe just closed down, citing high energy prices, which will make basically it impossible for them to make a profit, so that affects zinc markets, that affects silver markets, and everything that's made with those. And that's just one smelter. This is happening across the continent. Businesses are being priced out by the energy. And it's estimated that if Russia was to take the nuclear option and basically cut all gas exports to Europe later this year, which they could still do, that on average companies would face a 20% earnings loss, which is massive, destructive to the economy. That uncertainty has even led to a spike in German Google searches for Brennholz firewood. Not awesome for a top economy to be worried about how we're going to get firewood to stay warm this winter. Switzerland even warning that there could be coming civil unrest due to energy shortfalls, saying that people will rebel. But how will rising fuel prices affect broader markets? Well, we already got a taste of that this year. The energy supply shocks of March and April, caused by very much this same issue, caused commodity prices to rise significantly. This hurt consumers globally. This disrupted supply chains. This caused inflation to surge like no tomorrow. And we're still suffering those inflation effects. And for investors, this has not been good news. Unless, of course, you're invested in oil and gas companies, of course, then you've been having a great year. The energy sector has actually outperformed the rest of the S&P 500 index so far in 2022 with 40% gains, as you can see on this chart here. But generally speaking, rising oil and gas prices are bad news for the average investor because it means it's going to increase the likelihood that central banks are going to have to intervene even more than they already are. We've already seen the EU central bank raising rates. We're going to see more interest rate increases coming in major economies trying to bring down that inflation. That creates more economic pain. Higher costs mean businesses don't grow as well. The economy slows down. People get fired from their jobs. Can't pay their bills. That triggers recession fears. Now does all that mean to stop investing? No, of course not. It means that the bear market, though, may be far from being over. Keep expectations modest for the rest of 2022. Personally, I'm going to keep buying throughout the bear market. I'm going to be buying Bitcoin. I'm going to be buying a few select altcoins, stocks, gold, maybe a little bit of silver, some real estate, yes. But just remember, we are still not out of the woods, and bear markets can last longer than you can remain solvent, right? But bear markets always do come to an end, so do keep that in mind as well. This will not go on forever. We could be in for a rough winter in the Northern Hemisphere, but after that, we might be into smooth sailing skies again. We shall see, of course. Anyway, just my two Satoshis for the day. Let me know what you think about all this down below in the comment section. Do you think the EU gas crisis is a real story, something investors should be worried about? Or is this all just overblown? It's not going to be a big issue. EU's got plenty of storage. They'll be fine. They'll figure it out. Curious to hear your thoughts in the comment section. Thanks so much for watching today's video, and peace out till next time.